If you've ever looked at an investment report, you've probably seen this one number pop up again and again, this Sharpe ratio. It's treated like the gold standard. It even won a Nobel Prize. But what if I told you it's got a fundamental flaw? What if it's actually kind of misleading you? Let's dig in. Okay, let's just jump right in with a simple question. You've got two funds to choose from, Fund A and Fund B. Looking at them, which one is the better investment? Well, take a look. They both have the exact same annual return. A pretty sweet 20%, so it's a tie, right? There's no way to tell. And that right there is the problem every investor faces. The headline return number just doesn't tell you the whole story. And this really gets to the heart of it, to the investor's big question: how do you really compare two different investments? Because the answer, of course, is all about risk. I mean, think about it. A 20% return you got from some wild, nail-biting gamble is a completely different beast than a 20% return you got from a slow, steady strategy. The real measure of performance is how much return you're getting for the amount of risk you had to take. So how in the world do you measure that? Well, back in the 1960s, an economist named William Sharpe came up with an idea so powerful it won him a Nobel Prize and basically changed finance forever. He called it, you guessed it, the Sharpe Ratio.
The Sharpe Ratio tries to answer one simple question: am I being paid enough for the roller coaster ride I'm on? It boils all that complexity down to a single, elegant number. And the rule of thumb is easy. The higher the ratio, the better your risk-adjusted return is.
So how does this whole thing work? Well, it's surprisingly simple. It's just your reward divided by your risk. First, you figure out the excess return. That's just your investment's return minus what you could have gotten risk-free, like from a government bond. Then you measure its risk, which in this case is just volatility. You divide that reward by the risk and boom, you've got your Sharpe ratio. And to give you some real-world context, the Sharpe ratio for the U.S. stock market, going all the way back to 1927, has been about 0.42. Now, certain strategies like momentum investing have actually scored quite a bit higher. And this is exactly why it became the industry standard. For the first time, it felt like there was a perfect, objective yardstick to compare completely different strategies. It leveled the playing field, letting investors see past just that flashy headline return. So it's perfect, right? The ultimate tool for any investor. Well, not quite. The Sharpe ratio has a huge, glaring problem, and it's actually hiding in plain sight, right in its own definition of risk. Okay, remember how we calculate it? That risk part of the equation is nothing more than volatility, how much the price of the investment bounces up and down. Lots of movement is considered high risk, a little movement is safe. Simple enough? And that's the problem. I mean, just ask yourself this. As an investor, do you really care if your portfolio is volatile because it's suddenly shooting up in value? Of course you don't. That's the kind of volatility we all dream of. See, the Sharpe ratio treats all volatility as equally bad. A massive, unexpected gain is treated as just as risky as a massive, devastating loss. So a strategy that's specifically designed to catch those huge home runs actually gets punished by this metric. It literally penalizes good volatility. But the problems don't stop there. There's a second, maybe even sneakier flaw, hiding in the way it calculates the return. Let's look at this super simple example. You start with $100. In year one, you have a great year, you're up 50%. You now have $150. Awesome. But in year two, you lose 50%. You actually end up with just $75. Now here's the absolute kicker. The Sharpe ratio uses the average return. In this case, that's plus 50 and minus 50, so the average is 0%. But your wallet doesn't care about averages. Your wallet cares about the actual compounded return, which was a 25% loss. And the more volatile an investment is, the bigger this gap between the math and reality becomes. So because of these pretty major flaws, people in finance realized we needed a better tool. And this led to a whole new generation of metrics, all designed to fix the Sharpe ratio's blind spots and give us a much more accurate picture of performance. Enter the Sortino ratio. It's one of the most popular fixes, and it's brilliant in its simplicity. First, instead of looking at all volatility, it only measures downside volatility. You know, the bad kind that actually makes you lose money. It completely ignores those big spikes up. And second, it uses the real compounded return you'd actually see in your account. Just like that, both of the Sharpe's big flaws are gone. And then there's another one, the gain-to-pain ratio, which is just as intuitive as it sounds. The logic here couldn't be simpler. You just add up all of your gains, and then you divide that number by the sum of all your losses. That's it. Like the Sortino, it only penalizes you for the pain of losing money, never for the gain of making it. So, what does this all mean? What's the big takeaway here? Well, it's really about adding a couple of new, sharper tools to your mental toolkit when you're looking at investments. First, and most importantly, never ever judge an investment just by its return. The Sharpe ratio was a huge leap forward, but now we know its weaknesses. It unfairly punishes good volatility, and it uses a misleading average return instead of the real compounded return that affects your bottom line. To get a clearer picture, it's worth looking at alternatives like the Sortino ratio, which focus only on the risk you actually care about, the risk of losing money. Look, the Sharpe ratio isn't useless, not at all, but it is definitely not the final word. It's just one tool, and it's a flawed one. So the next time you see it on a report, just ask yourself, is this really telling the whole story? And that leaves us with one final thought. Are you measuring what truly matters?